Welcome to Staff Works Explained. If you are here for the first time, please consider subscribing to this channel, or you can also hit the notification bell so that whenever we upload a new video, you are notified. Also, give us your thoughts about the topic that you are about to discuss: Tullow oil exiting in Kenya. In this video, we'll look at what is the deal that Tullow oil made with Gulf Energy of Kenya, how much the deal was worth, the immediate effects or benefits that Tullow will get, and even the Kenya economy. What future payments are included in the deal? Can Tullow return to the project in the future? We'll also try to answer the question, how does the sale impact Tullow financial position? We'll also look at who is Gulf Energy. What role do they play in the Kenyan oil and also in this deal? Also, what are the final steps before the deal is complete? If you have been listening to news or watching news, you could have not missed an item where on April 15th, 2025, Tullow Oil PLC, which is a UK-based oil and gas company, announced that it was selling 100% of its Kenya's operation, which is Tullow Kenya BV, and this was to Gulf Energy Limited, a major Kenyan energy and infrastructure company. This sale represents a complete exit by Tullow Oil from its Kenya portfolio. After years of struggling to push forward Kenya's first major oil project, Tullow is now transferring all its licenses, operations, assets, as well as future obligations to Gulf Energy. However, Tullow has preserved a strategic back-in right, meaning that it can later rejoin the project at a 30% stake without any cost for future exploration and development phases. This clever arrangement, and this ensures that if the oil project eventually succeeds, Tullow still has the opportunity to benefit while avoiding current risks and investment. So what's the structure of this deal? The minimum total amount that Tullow will earn from selling its Kenyan assets is $120 million US. This is equivalent to 15.6 billion Kenya shillings. The payments are divided into three parts, which are called tranches, each triggered by specific events or conditions. Tranche A, or Part A, is where there will be an immediate payment of 40 million, which is equivalent to 5.2 billion going by the current exchange rate. Tullow will receive 40 million, about 5.2 billion Kenya shillings, once the deal is finalized, and this is expected to come later in 2025. This is an upfront cash payment guaranteed once regulatory approvals and paperwork are complete. This provides Tullow with immediate funds to strengthen its finances, reduce debt, as well as improve liquidity. As soon as the sale is completed, Tullow gets a major cash injection of 5.2 billion or 40 million US. Tranche B, which is a payment tied to project approval, this will be 40 million also, equivalent of 5.2 billion Kenya shillings. This is where another 40 million will be paid when either the Kenya government approves the Field Development Plan, or FDP, or 30 June 26 arrives, whichever happened first. We know that FDP is a government authorized blueprint outlining the oil fields, how they will be developed for large scale production. Here in this tranche, Tullow Oil will either get another 5.2 billion Kenya shillings when the Kenya government says go ahead with the project, or automatically by mid 2026 if no decision has been made. The third tranche C, which is oil price linked installment of 40 million. The final 40 million is paid gradually from late 2028 through mid 2023. Tullow Oil will receive 2 million, about 260 million Kenya shillings every quarter only if average Brent oil price stays above $65 per barrel. If oil prices are too low, then and the full amount has not been paid by June 2023, during 2033, Gulf Energy must pay the full balance all at once, which is a bullet payment regardless of oil market conditions. So in simple terms, you can say that starting in 2028 or late 2028, Tullow collects 260 million every 3 months if the oil prices are good. If not, Gulf Energy pays everything they owe in lump sum by mid 2023. Why is the structure this way? Gulf Energy gets protection against low prices by spreading the risk. Tullow is assured that even if oil prices crash, it will still eventually collect the full 15.6 billion Kenya shillings. The structure also gives Tullow quick money now, tranche A and tranche B, and long-term income, tranche C. There is also a tranche D, which is a loyalty payment, which we can say is an extra ongoing income. In addition to 120 million or 15.6 billion Kenya shillings, there's a Tullow Oil will continue to earn a royalty from the project if it becomes successful. Here is how it works. Tullow Oil will receive 0.5 US dollars, which is about Kenya shilling 65, for every barrel of oil that is produced from 80% of the total production. This royalty is a conditional, meaning Tullow Oil will only get this income if certain undisclosed conditions are met. These most likely include a minimum oil price being maintained, the project achieving commercial sale production, as well as the availability of enough oil reserves to sustain the output. Simply, what we are saying is that even though Tullow Oil is selling Kenya business, it keeps a small tap open. If oil flows and the project succeeds, they continue to make money passively over time. Why is Tullow selling? Tullow Oil has faced financial challenges for several years. Its African portfolio outside Ghana, notably Kenya and Uganda, required heavy investment but had slow returns. The Lokicha oil project in Kenya, despite significant discoveries which were made in 2012, was delayed by years due to infrastructure bottlenecks, specifically lack of export pipeline. There were also community disputes as well as financing difficulties, lower oil prices, taking long for FDP to be approved. In 2020, Tullow had already sold larger part of its Ugandan operations to Total Energy and was gradually shifting focus on debt reduction as well as streamlining its portfolio. This sale aligns with the Tullow broader strategy of focusing on high margin production, especially offshore Ghana, rather than tying up cash in this undeveloped asset. By exiting Kenya or by leaving Kenya, Tullow is reducing its debt burden. It's also removing its capital expenditure obligation in Kenya. Its transfer of past, present, as well as future liability associated with Kenyan operations to Gulf Energy. It is strengthening its ability to refinance its corporate debt, especially after the earlier $300 million sale of its Gabonese assets. Let's talk now about the Gulf Energy, its position as well as its strategy. This company was founded in 2005 and is a leading East African energy company. Its operations include oil and gas trading, where it supplies petroleum products across Kenya and as well as neighboring markets. It is also involved in power generation, where it operates an 80 megawatts at river thermal power station, and this helps in contributing to the Kenya electricity grid. It is also engaged in retail and commercial services, where it supplies fuel and energy solutions to businesses as well as export markets. The company has shown strong financial stability, backed by a reputable international banks as well as shareholders. The company's move into oil exploration and production marks a natural expansion from its core trading and power business. Owning upstream, which is production assets, allows Gulfstream to control more of the energy value chain, from exploration to retail distribution. This acquisition also reflects a broader trend in the African energy market, where local and regional companies are increasingly taking over assets of multinational oil majors that are downsizing in their African portfolios. Let's now look at regulatory and legal considerations that need to be considered for this deal to be completed. Because of its size, the transaction is classified as a significant transaction under the UK listing rules UKLR7, which was implemented in 2024. This triggers a mandatory public disclosure, possible shareholder approval, as well as close scrutiny from financial regulators. The deal is not immediately final. There are several key conditions that has to be met. One is that Kenya government and regulatory authorities must approve the transfer of oil licenses and interest. Gulf Energy must also provide payment guarantee for tranches B and C. A full sale and purchase agreement (SPA) must be signed, and currently only a preliminary head of terms agreement has been announced. Until these steps are completed, the transaction remains conditional. What's the strategic importance of this for Kenya? Kenya has long aspired to become an oil producer, and significant discoveries were made in South Lokisha Basin in Turkana over 15 years ago or 13 years ago. But commercial production has stalled. Problems included the absence of export pipeline. There is a complex land rights and community relations, as well as high cost estimate for the development. The entry of a Kenyan-owned company like Gulf Energy could breathe a new life into the project. Being local, Gulf Energy may be positioned better to navigate political, logistical, as well as community issues compared to a foreign operator. There's also a sense of national pride in having a Kenyan firm lead the Kenya first major oil project. If the field development plan is approved soon, Kenya could move closer to first oil exports, a significant milestone for its economy. In conclusion, we can say that this deal marks a major realignment in East African energy landscape. Tullow Oil, after many years of investment and setback, is retreating from Kenya to focus on safer and more profitable ventures elsewhere. Gulf Energy, with strong local knowledge and financial strength, steps forward to lead the development of Kenya oil sector. However, the future success of this venture depends on several factors, such as stable oil prices, government support, Gulf Energy technical capabilities, as well as completion of key infrastructure like pipelines. If all aligns well, Kenya could finally unlock the potential of its oil reserves, and Gulf Energy could emerge as a powerful new upstream oil producer in East Africa. So thank you for reaching this far. Let's hear your thoughts about this shift or this exit of Tullow Oil from Kenya, and also whether this deal will become fruitful and successful. Thank you.